So this is where doing your due diligence and putting in the little extra work could find these little gems in the market. And welcome back, investors. My name's Colton. I am definitely a value/GARP investor. Today we're going to dive into a stock that was requested by one of our subscribers. And if you like this type of process, make sure you like and subscribe, hit that bell. So anytime I go live or drop a video, you get alerted. I don't recommend picking individual stocks. I recommend just dollar cost averaging into a broadly diversified index. Set it and forget it. Those people that are interested in a process and buying and taking on a little bit more risk, this might be the right channel for you, so let's get into it. Now, the stock we're going to talk about today is going to be dLocal Limited, or DLO. This is a very fast-growing payment processing emerging market stock, so it hits on a lot of cylinders that I'm actually personally looking forward to add in my portfolio. But before we get into this stock, if you are new to investing, I definitely recommend checking out Charles Schwab. As they just merged with TD Ameritrade, now they offer, in my opinion, some of the best platforms to use for free. Everything from dividend income projections to phenomenal charting when it comes down to the Thinkorswim platform. So if you're interested in going with a reputable brokerage, I highly recommend Charles Schwab. I don't get paid to advertise their stuff, but if you want to click the link in the description, you can get up to $1,000 for opening up a brokerage account with Charles Schwab. So back to ticker symbol DLO, this was a stock trading for over $20 a share, and after recent earnings fell to $9.59. Currently trading at 22 times earnings, which is actually fairly reasonable when we compare that to a market multiple, and definitely outgrowing most stocks in the S&P 500. Now, when we do a surface level check on this company, there was almost nothing I can find wrong with it. Unbelievable top line revenue growth. Share count is actually staying flat to down. And check out earnings per share. Now, if you're new to the channel, what do we always say on this channel? Stock price will follow earnings per share. And when we bring it down to a free cash flow per share, just a beautiful upward trajectory. So when I look at the fundamentals just from a surface level scratch, I have to dig deeper into this company because to me, this is an unbelievable opportunity to see this exponential growth with a market multiple on the stock. Top line revenue growth has been doing over 55% for 4 consecutive years. When we check the sentiment around the stock, everything from a $15 price target as high as a $24 price target, which means that there could be a tremendous opportunity within this equity here. And when we look at where projected growth was going, still projected to do over 30% growth for the foreseeable future. And this is a company that deploys capital extremely well. Return on equity is 30% and return on invested capital is over 27%. Very, very high marks across all aspects here. Strong margins, strong free cash flow, EPS growth, return on invested capital. This is hitting on all cylinders. So what recently happened? Why did the stock sell off? For first quarter 2024, they did $5.3 billion in total payment volumes, or they call it TBV, which is up 49% year over year and 4% quarter over quarter. So we're starting to see this growth rate of 50% really start to slow down here, especially from a quarter perspective. Now, just to get an idea, $5.3 billion in a quarter, when we compare that to a PayPal, total payment volume for PayPal reached $403 billion. So we can see that obviously the size of this company, when we compare it to PayPal, is substantially smaller, but it does have that growth trajectory and it does have that emerging market exposure that I really like here. And just a beautiful upward trajectory of revenue and earnings following. But with recent earnings, the stock is down nearly 50%. So we're going to dive into the earnings and project out what we think this company is capable of doing. If the numbers start making sense when we plug in our analysis, then we have to start listening to the conference call and just make sure everything is lining up before we purchase the stock. But this one is definitely looking interesting just from a scratching in the surface. So here's where we have to pump the brakes. Gross profits hit $63 million, up 2% year over year and down 10% quarter over quarter, which, you're paying a premium for this stock. It's in a growth phase, but all of a sudden we're starting to see that the growth is slowing down, but then there is some other issues taking place when it looks like expenses could be the problem here when we look at gross profits. It did $37 million, down 19% year over year and negative 25% quarter over quarter. So we see this huge reversal with the stock. It was in a beautiful upward direction, and all of a sudden it just reversed when we talk about margins extremely to the other side here. And so here's where the quarter is going haywire here. They're still getting that nice top line revenue growth of roughly 34%, not the high 40s and low 55%, but now it's in 34%. But the other thing that we have to look at is gross profit margins are coming down very, very quick here. Profit margins went from 26% down to 10%. So now the question becomes, with this company, can we see margins stabilize? But the one thing you cannot deny with this company is the emerging exposure that they're getting here. 17% growth in Brazil, 15% growth in Argentina, 17% growth in Mexico, 10% in Chile. You're seeing double-digit growth in a lot of emerging markets here. And to me, this is an interesting way to actually play emerging market growth. dLocal Limited could have tremendous footprint and exposure to the growth of these emerging markets. And so a few things I want to point out. There is a little bit of dilution coming on here, but not anything too crazy here. And there was a pretty substantial drop in earnings per share. So the two things I really want to point out where the fundamentals are kind of getting jacked up here is going to be cost of services going almost double of cost of services. This is something you definitely want to dig into to figure out if this was just a blip or if this is going to kind of be where the trajectory is going. Secondly is a big spike up in general and administration, which could be the fact that they're growing very rapidly. So that you kind of have to figure out, is this more of a one-time cost and we're going to see it come back down, or is this kind of the new norm? They have a good balance sheet here of $572 million of cash and cash equivalents. And I'm not seeing any sort of short-term or long-term debt due for the company. So this is a very clean balance sheet. So here comes the art to investing when we start plugging in our models. What kind of return are we looking for? What kind of margins do we think this company can stabilize at? Because this was a company doing over 30% margins, now down 20%. The other thing is, what kind of growth rates do we really want to put on the company now that we saw growth take a substantial hit here? So for me, on a sell-off like this, on a company that still has growth potential, I think building the most amount of safety makes the most amount of sense, especially after this kind of sell-off. Over the next 5 years, Yahoo's projecting to do about 26% revenue growth. And on stock analysis, we can see that they're projected to do right around high 20s, low 30s for an extended period of time. I'm going to shoot underneath this. So right off the bat, I'm already starting to build some safety here. We see that the EBITDA margins are usually in the 30 percentile, but now we saw a massive hit, and I think this could be the new norm. When we talk about payment processors, the thing that's scary about payment processors is now there's a tremendous amount of competition, which means that this is going to impact margins. So this story of lower margins could definitely be a story that plays going forward. But with the clean balance sheet and the fact that they have a decent sized footprint here, I'm not so sure that we can count them out. So I definitely want to keep working with lower margin business here and just see what we get for a price target. So we're going to do 18% margins, 19% margins, and we'll say that they get back to 22% margins. That's kind of where they're going to mature out, is around 22% margins. So I don't think I'm doing anything outlandish here. I'm putting in projections that I think are realistic. I'm putting in margins that I think are realistic. And so now the question becomes, what kind of multiple do we want to put on the stock? So it looks like a 12 multiple could make a lot of sense. Currently trading around 12 times enterprise value to EBITDA, and industry standards sitting right around 12. So looking for a double-digit rate of return, a few percentage points than what the S&P 500 is giving us. So we get two price targets here. From a discounted cash flow analysis, we get just under $10 a share. And from our multiple to EBITDA, we get right around $7 a share. Now remember, I built a decent amount of safety in here. So plus the $7 gives us 16 divided by 2. We get an ideal price target around $8.35. I think anything under $9 is extremely interesting, but I think you have to understand that the direction that the recent quarter showed us is probably a direction we want to be cautious of. So maybe waiting for another earnings release, or possibly starting to listen to some of the earnings calls to see if anything can shed some light on why margins were compromised so much for the quarter, if it was a one-time issue or if this is something longer term. If this was a one-time issue, ladies and gentlemen, this is what I want to show you guys. This is where you can unlock a tremendous amount of value doing a little bit more research here. So let's say that they get their margins back on the right direction and they do 22% margins, 23% margins, and they get closer to that 30%, 40% margins that they used to have. Well, ladies and gentlemen, the stock is a buy pretty much right now. What I like about this company is the emerging market exposure, the growth opportunity, and it seems like it's reasonably priced after the sell-off. So that was just my quick dive into ticker symbol DLO. Obviously, you guys see here that there's still more work to do if this is something I want to invest in. Do I trust management to execute? Are the margins a short-term headwind that is a long-term buying opportunity? Or is this something that is significantly changing within their business model? But overall, I think this is an extremely well positioned and interesting company. They're pretty much doing everything you could possibly ask. They're getting earnings per share growth, they're getting revenue growth, they're not diluting the investor. They have a pretty solid balance sheet. A lot of things to like about this small cap company that we just went over. So if you like this kind of material, make sure you like and subscribe, smash that thumbs up, get that content out there, and we will see you in the next one.